Leaving your job? What happens to your pension? You just left your job, or maybe you're thinking about it. And now you're wondering, what happens to your pension? Can you take it with you? Should you leave it where it is? Or do you have other options? We're breaking it all down in simple terms. Welcome to the channel. My name is Anthony Gismondi, Senior Wealth Advisor with Aegis Wealth Management, a part of Wellington-Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. What happens when you leave your job? So you've left your employer. Maybe you found a better opportunity. Maybe you got laid off. Or you retired. Whatever the reason, if you had a pension plan with your employer, you now have an important decision to make. Depending on the type of pension you had, you typically have a few options. Number one, leave it where it is, which is sometimes allowed for defined benefit pensions. Number two, transfer it to a new employer's plan if your new employer offers one and allows transfers. Number three, move it into a locked-in retirement account or LIRA if you're in Canada, or in a similar tax-sheltered account if you're elsewhere. Number four, cash it out, but beware. This usually comes with taxes and penalties. In most cases, it's not the smartest move. What is a LIRA? And what happens when you convert to a LIF? So if you decide to transfer your pension, a common option is a locked-in retirement account, or LIRA. Think of a LIRA like an RRSP, but with a big padlock on it. You can't touch it until you reach your retirement age, and even then, you can't just withdraw it all at once. Once you hit retirement, your LIRA needs to be converted into a life income fund, or LIF. A LIF is what allows you to start withdrawing money in retirement, but only in set amounts each year based on government rules. So you get a steady income instead of blowing it all on a yacht the day you retire. Withdrawals generally cannot be taken directly from a LIRA account. A LIRA can be converted into a life income fund, or LIF, or similar account to begin withdrawals, or it can be used to purchase a life annuity from an insurance company that makes ongoing payments. Withdrawals before a certain age may not be permitted, depending on the province, but some allow withdrawals in extraordinary situations. Examples include shortened life expectancy, financial hardship, and non-residency if you move away from that jurisdiction. Up to 50% of a federally regulated LIF can be unlocked and transferred to an RRSP for those aged 55 and older. Alberta, Manitoba, and Ontario pensions also allow a LIF to be unlocked to transfer up to 50% to a non-locked-in retirement account after age 50 in Alberta and in age 55 in Manitoba and Ontario. Transferring a defined contribution, or DC pension plan. Now, if you had a defined contribution, or DC plan, transferring it is pretty straightforward. A DC plan is basically a pension where you and your employer both contributed to an investment account over time. You know how much each party has contributed and how much you have earned, but your retirement income is not fixed and will be subject to investment returns. When you leave, you usually have two choices. Number one, transfer the funds to a LIRA and keep them growing tax-free until retirement. Number two, move them to your new employer's pension plan if that's allowed. If you don't transfer your funds within a certain period, some employers might leave the money in the plan or force you to withdraw it, so don't wait too long to decide. Transferring a defined benefit, or DB pension plan. Defined benefit, or DB plans, are a little different. These are pensions where your employer guarantees you a certain monthly payment in retirement based on things like salary and years of service. When you leave your job, you typically have two options. Number one, leave it in the plan and collect a pension when you retire. Number two, take the commuted value, a lump sum, and transfer it to a LIRA. But be careful, only a portion of that lump sum can go into a LIRA tax-free, the rest might be taxable immediately. A big thing to consider: if you take the lump sum and transfer it to a LIRA, you take the responsibility of managing the money yourself. If you leave it in the pension plan, your former employer continues to manage the risk for you. So think carefully about what makes sense for your situation. In many instances, the maximum transfer value set by the Income Tax Act prevents the full amount of a pension entitlement from being transferred to a LIRA. Under Regulation 8517, this limit is determined by multiplying an age-based factor by the annual pension benefit. However, this calculation does not account for additional benefits such as indexing or early retirement provisions, meaning the maximum transfer amount is often lower than the true value of the pension. As a result, a portion of the commuted value may not be eligible for transfer and must be received as a taxable lump sum payment. This can lead to significant tax liability. While individuals with available RRSP contribution room may be able to mitigate some of the tax impact by making a contribution, many do not have sufficient room due to pension adjustments that have reduced their annual RRSP limits. In certain cases, a pension adjustment reversal, or PAR, may be available, which can help restore lost RRSP contribution room. This is covered in more detail in the section on pension adjustment reversals. Here's an example of a maximum transfer value calculation. Consider an individual leaving their employer at age 50 with a commuted pension value of $350,000 and an annual pension benefit of $27,000, payable at age 65 and indexed at 2% per year. Under the Income Tax Act, the maximum direct transfer to a LIRA is calculated as follows. The $27,000 times the 9.4 factor equals $253,800. The remaining $96,200 must be taken as a taxable lump sum. Assuming a 45% tax rate, the after-tax amount received would be about $52,910. If both amounts are invested, the $253,800 in a LIRA and the $52,910 in a taxable account over 15 years, an annual return of 2.28% would be required to accumulate $430,384, the amount needed at age 65 to generate that equivalent $27,000 indexed pension income. Alternatively, if the $52,910 is spent rather than investment, the LIRA balance of $253,800 would need an annual return of 3.58% to achieve the same outcome. In some cases, despite the tax liability, transferring a commuted pension may still be a viable choice. However, when comparing this option to an immediate pension payout, such as early retirement, commuting can often be less advantageous due to the taxable portion of the transfer. In many cases, the employer-sponsored pension plan may offer better long-term financial security. Factors to consider before moving a pension. Number 1, risk profile. The idea of managing investments is as thrilling to some clients as it is frightening to others. You need a proper understanding of your tolerance for risk. Number 2, broader finances. The size and nature of a client's family assets and their other sources of retirement income, including Canada Pension Plan, Old Age Security, RRSPs, and TFSAs, will help determine how dependent the client will be on their workplace pension. Number 3, age. Younger clients with fewer pension assets are generally better off consolidating their balances in their own LIRA to ensure the assets are not lost or forgotten in years to come. Number 4, health. Eligibility for supplementary benefits, such as life insurance and drug and dental coverage, are frequently overlooked by departing plan members. Clients with health issues that could shorten their life expectancy can decide to commute their DB pension in order to maximize the money in their estate. Number 5, Institutional solvency. Clients should check pension solvency disclosures to get an idea of the health of their DB plan. They should be advised that these statements can fluctuate significantly from year to year because of the variables involved in calculating the cost of future obligations. And there you have it, everything you need to know about transferring your pension when you leave your job. If you found this helpful, don't forget to like, subscribe, and drop any questions in the comments below. Have you transferred a pension before? Let me know your experience. Thanks for watching, and I'll see you in the next one.